Why are U.S. companies sitting on so much cash? I mean, just mountains of it. Is that a sign of incredible strength, or is it a massive failure of imagination? We're going to dive deep into the fantastic work of Mauboussin and Dan Callahan to figure out exactly what this means for us as investors.
First, let's just get our heads around the scale here. At the end of 2024, U.S. public companies were holding almost $2.5 trillion in cash and short-term investments. That is just a staggering number, about 4.7% of the entire market cap.
So this really brings us to the core of the debate, doesn't it? Is this giant pile of cash a war chest, ready to fund the next big innovation or pounce on an opportunity, or is it just a sign of poor capital allocation, money that really should be working a lot harder for shareholders?
To answer that, we've got to do some digging. We have to look at the data. Who exactly is holding all this cash, and what's really driving this trend? Well, it turns out the answer points to a massive fundamental shift in our entire economy.
Okay, so the single biggest factor, the main culprit, if you will, behind this explosion in corporate cash is this huge shift in our economy. We've moved from a world that was dominated by physical stuff to one that's driven by ideas, by knowledge, what we call the intangible economy.
These modern companies, they're built on intangible assets. So we're not talking about physical factories anymore. We're talking about things like source code, drug patents, brand recognition. And in a lot of ways, these have become the most powerful economic moats in business today.
And right here, this is the critical difference when it comes to a company's capital structure. A bank, well, they'll happily lend you money against a factory, but try getting a loan against a block of software code. It's not going to happen. Intangible assets are just terrible collateral, and that limits a company's ability to take on debt. So what happens? These firms are forced to self-fund, which means they need way more cash on hand.
The data really drives this point home. Just look at the sectors with the highest intangible intensity. They hold the most cash, by far. Healthcare, which is all about R&D, holds a median of 39% of its assets in cash. Infotech is right behind at 23%. Now compare that to a classic tangible asset business like energy. They hold just 4%.
But it's not just about what a company does. It's also about where it is in its journey. The corporate life cycle gives us another really powerful way to understand why a company has the cash balance it does.
And the data here reveals this fascinating U-shape. Check this out. Companies in that early introduction stage hold the most cash. We're talking over 31% of assets. Then, as they mature and grow, their cash needs drop, and they bottom out around 8%. But then, look what happens. As companies enter decline, their cash holdings shoot right back up to over 20%.
And the logic behind this is actually pretty simple when you think about it. Young companies are burning through cash to build their business, long before they're profitable. And declining companies? Well, they're burning cash to restructure or, frankly, just to stay afloat. It's the mature companies, the ones right in that sweet spot, that are the real cash machines. They generate way more than they need.
Okay, so we know who's holding the cash, and we have some pretty good clues as to why. But let's dig even deeper into the specific motives that push a management team to build a literal fortress of cash on their balance sheet.
The research really boils it all down to three main motives. First, there's the precautionary motive. Basically, cash as an insurance policy. Second, you've got the optionality motive. That's cash as dry powder, as firepower. And then finally, there's the agency motive, which gets into the conflict between what's best for managers and what's best for the owners.
This quote about Warren Buffett, it just perfectly captures that optionality motive. I mean, think back to the 2008 financial crisis. While everyone else was panicking, Berkshire Hathaway had the cash to make these life-saving and incredibly profitable investments in companies like Goldman Sachs. That is the power of optionality. Cash is your ticket to play when everyone else is forced to sit on the sidelines.
Now this brings us to agency theory, and this is really important. See, shareholders like us, we're diversified. We want managers to take smart, calculated risks to maximize value, but an executive, their personal wealth, their career, it's all tied up in this one company. So they have this natural incentive to reduce their own personal risk by keeping a huge cash cushion, even if it's not the most efficient thing for the actual owners of the business.
So, you might be wondering, is there any hard evidence of these agency costs out there in the real world? Oh yeah, and it's powerful. Studies show that public companies hold roughly twice as much cash as comparable private firms. Just think about that for a second. Private firms, which often have a tougher time getting capital, run so much leaner. This is probably one of the strongest signs we have that a lot of public companies are holding way more cash than they actually need.
So this all leads us to the final and maybe the most crucial question for us as investors. If a company has a ton of excess cash, what should it do with it? How should it get that capital back to its rightful owners, the shareholders, in a way that actually maximizes value?
You know, share buybacks have become so controversial lately. But as Warren Buffett so colorfully points out, a lot of the criticism is just wrong. To really analyze buybacks the right way, we have to cut through all that noise and understand how they actually work.
So let's just tackle the biggest criticism head-on, the idea that buybacks are just some financial gimmick to goose the earnings per share number and trigger executive bonuses. And kind of depressingly, surveys of CFOs actually confirm that this is often a real motivation.
And here's the critical lesson for every investor out there. The academic evidence is just overwhelming on this. When management repurchases shares simply to hit an EPS target without any regard to the stock's valuation, it very often destroys value for the shareholders who stick around. It's the classic case of hitting the target but completely missing the point.
So here's the crucial mental model. A buyback in and of itself doesn't create or destroy any corporate value. It is simply a transfer of wealth. It's that simple. If a company buys back its stock for less than it's truly worth, its intrinsic value, it makes the remaining long-term shareholders wealthier. But if it overpays, it transfers wealth away from the ongoing shareholders to the people who are selling. It is all about the price you pay.
All right, let's pull this all together into a practical framework that you can use. When you're looking at any company, just ask yourself these 4 questions. First, why are they holding this much cash? Is it for precaution, optionality, or is it an agency issue? Second, does that cash level actually make sense for its industry and its stage in the life cycle? Third, if they do have excess cash, are they disciplined about returning it? And finally, and this is the big one, are their buybacks actually creating value by being done below intrinsic value?
And we'll end with this one last kind of provocative piece of data. While $2.5 trillion sounds absolutely massive, U.S. firms are actually less cash-heavy than their peers in most other global markets. So is this a sign of superior capital discipline by American managers? Or is it a warning sign that maybe they're underestimating the risks and opportunities that lie ahead? The answer to that question could be worth trillions.